Hello, everyone. Hello. I'm going to give a few seconds for folks um, to get in. All right. Welcome to Association Insights. This is your part-time controller's first national webinar designed specifically with associations in mind. Welcome, everyone. All right. I think we can get started. I'll go to the next slide and just tell you a little bit about your part-time controller, or YPTC, as you will hear us refer to ourselves. We have over 30 years experience in nonprofit financial management. The services that we offer range from everything in dealing with everything we need to do to close your books, month end close, reporting, including data visualization and analysis, as well as implementing best practices and internal controls. We can do that on an interim or an outsourced basis. We work across the nation remotely, and we have 12 regional offices where we can work in a hybrid way or in person. And we have, like I said, we have over 3 decades of experience. I'm going to read this slide pretty much word for word so that I don't mess anything up. This is a big housekeeping item. This is a free webinar, and we are pleased to be able to offer CPE credit. And we ask for only one thing in return, which is your presence. We pack a lot of incredible knowledge and tips in our webinars, and so there's potential for you to really take away something other than just CPE. But to obtain the CPE, you have to do 2 things. First, be on the live webinar for at least 50 minutes. And second, respond to 3 of the 4 poll questions that will appear. Note that you'll need to click directly on the screen to respond to the poll questions, and I'll try to remind you as those poll questions come up. Keep in mind that you have to scroll down, you might have to scroll down on the pop-up in order to press the submit button. You can track your viewing progress in the Earn CPE widget on your screen throughout the webinar. And while you have the flexibility to customize your console and On24 by repositioning or resizing any of the windows, we recommend that you don't do this because if you wish to expand the view, please don't maximize any window to full screen mode, because that might hide the pop-ups, and then you might miss the questions, the poll questions, and not be able to answer the poll questions when they appear. By registering for today's event, you will automatically receive an email after 24 hours that will have a link to download the slides and a link to view the recording. So in 24 hours, you will get a copy of the slides and a chance to view the recording, review the webinar. If you meet all the criteria for the CPE, you'll also get a link to get your CPE certificate in that email as well. Just remember that it does take 24 hours to do this, and so just look for it sometime tomorrow Wednesday afternoon. I'll also note that our related content and contact information, along with a copy of the slides, can easily be accessed in the related content widget. We don't have any additional information for you, but you can at least pull the information on the slides in the related content widget. And finally, you can see and hear us, but we can't see or hear you. So if you would like to ask a question, please submit the questions through our Q&A widget entitled Ask the Presenter a Question in the bottom toolbar. We love to hear your questions, and we'll do our best to address them throughout the presentation or at the end. And with that, I'm happy to introduce our speaker. So my name is Teresa Henderson. I am the vertical market leader for the association specialization. I've been with YPTC for 11 years. I'm working with associations and nonprofit throughout that time. My colleague joining me today is Sharon Sinclair. Sharon, why don't you say hello and say a few words about yourself?
Thank you. Hi, I'm Sharon St. Clair. I'm a manager at your part-time controller. based out of the Washington, D.C. office. I have 30 plus years of experience working with nonprofits and associations. I bring hands-on experience as I have worked inside an association for many years. Um, and I'm happy to be working alongside Teresa as part of the association special group here at YPTC.
Thanks. And I'm very excited to also present to you, we're partnering today with Dr. Michael Tatonetti. He is the founder and the principal consultant at Pricing for Associations. Michael, go ahead and introduce yourself and say a few words.
Yeah, hello everybody. So I'm Michael. I'm the founder of Pricing for Associations, and we are a consulting firm that works with associations on pricing and value strategy. So whether you're pricing membership, events, certifications, education, sponsorship, whatever the product is, we work on setting the right price and making sure that you're delivering the right value to your audience. And I'm both a certified association executive. I'm also a certified pricing professional. So I love sitting at that intersection of price, value, and associations.
Great. Yes, we're very excited that you're joining us. Thank you for joining us today. I'll just read through a few of our learning objectives so we can get down to the exciting stuff. Today, we're really focusing on talking about the emerging challenges and pricing strategies for nonprofit associations. We want to identify what are some of the common financial metrics that we can use to convey the value to association stakeholders. And of course, share best practices and lessons learned from our experience in the association industry. So here is the first of those poll questions I talked about. And remember, you have to click on the screen to select the answer. Who's joining us today? It just helps us to make sure that we can tailor our comments to make sure that we are getting the most out of it. Do we have auditors here, executive directors, CEOs, finance team members, AMC staff members, or other? Did we miss your job title? And if we did, why don't you, just to kind of let us know in that Q&A box, since we don't have a chat box, go ahead and type your job title so we can, again, just see who's here and who's joining us today.
I want to point out, though, if you do pick other, you still have to click other on the screen to get your CPE credit.
Great reminder. That's a great reminder. As people are responding, I also just want to kind of point out that today's webinar is going to be a little bit different. Maybe if you've joined YPTC training before, and this is going to be a little bit more free-flowing. There are, like you said, there are slides, but we're really focusing on the discussion today between the panelists. I think you'll find them both very interesting. I'm really excited to hear what they have to say. So yeah, so I think that we're pretty close to the poll. Looks like we can go to the next slide and see who we've got here. So auditors, a few, executive directors, welcome. We're glad to see you. Finance team members, these are our people. Finance team members, thank you for joining us. We've got a few folks from AMCs and then other. So let's see what we have in the other box. Yeah, definitely. We've got
I think we have quite a few consultants in our others, so we're always happy to have those as well.
Absolutely, absolutely. Somebody's missing the poll. I think the poll question, you may have it hidden. If we've got somebody who can help our person who's missing the poll or type in polls, you can let me know. We've got some folks helping us in the background, so they may be able to type in the chat. Let me know how to help folks find the poll if they can't. But I'm going to go on to the next slide to get us started. And so just to say, you know, what are some of the emerging challenges for nonprofit associations? Again, that's kind of the context for this webinar. And, you know, with inflation being such a big topic, and you know, we're always as financial people, we're always really focused on, you know, how can we help the organizations that we support make sure that they're thinking about financial stability. This is really what the origin of today is about. And I know, Sharon, you've kind of faced a situation not only that where you had some financial challenges, but it specifically dealt with this area. So why don't you kick us off right here?
Absolutely. So, setting the stage here, I thought this would be a great opportunity to share a story about an experience I had several years ago, well before COVID. But I was working with a state association in the medical field. They had been doing extremely well for many years, had strong financial statements, and had cash reserves on hand to cover over a year of their average expenses. And I know right now there's a lot of people sitting here listening saying, well, this doesn't apply to me. Hold that thought, because as all good things happen, change did happen to this organization. And so in this case, the CEO decided after many years of service, it was time for him to retire. And when he retired, they went out and did a national search, as all of your organizations do as well. We had put together a budget range for the new CEO, and they found the person they wanted as a replacement came in significantly higher than the original amount we budgeted for. Then, as all good CEOs like to do, he wanted to bring on a strong team. He hired two senior vice presidents to help fill out his C-suite. And in doing so, these were unbudgeted items. So with this organization, I had been working with them for a couple years as an outsourced fractional CFO controller. They did not tell me about this until after everything was signed. So it was a little bit of surprise when I had to approach the new CEO as he came in the door and let him know that he was going to be running a deficit. And based on our projections, he would use up all those cash reserves in less than 6 months. So more to come on this story, but I will let you know, like all good organizations, we look at our expenses, and in this case, the expenses were definitely the issue. So we turned to what could we do to raise more revenue? That's always got to be the answer. If we know our expenses, then it's got to be we just raise some more revenue. So with that, Michael, I'm going to kind of hold off on the rest of my story till later. But Michael, is this a situation that you see in your practice?
It is. I will say this is a little bit of a unique scenario in which the cart is before the horse, where they're making financial decisions and they're hiring without regard to what budget is available. But the idea that prices have not been raised in quite a while, it's very common when I do trainings. Both of you have sat in training with me. That's actually how we met. And I typically will ask the question at the beginning, how often do you raise your prices? And it is very common that people say it's been 5, 10, 20 years. So that part is very normal. But living beyond our means as an organization is usually not. So I'm excited to hear how this ends, hopefully in a good way. But it's very common. I'm sure most of the people on this call would say it's been at least a few years since they've raised prices across the board.
Yeah, I think that's interesting. So I won't say it happens to us a lot, but again, as finance people, I think that is something that we're comfortable with. When we think about the budget, we're comfortable in dealing with the expense side because we can use historical information, or maybe there's other benchmarking information out there where we can control the expense side. And thinking about the revenue side, it's a little bit maybe less structured or a little bit softer for us. And so again, that's one of the reasons that we're happy that you're here. So tell us a little bit about what the process is that you use to start to think about prices and the revenue side. What is the process that you use?
Yeah, so there are typically 5 steps that I'm looking at when I'm determining price. Now, of course, you could do less, you could do more, but this is what I typically recommend. The first thing that I have any organization do is a historical data analysis. Before we start with what the board wants, the staff, or the squeaky wheels, the people that we hear at our conference, we love everyone and everyone's voice matters. But our board is a specific segment of people who have done great things in our field, and that's why they're on the board, but they do not represent everybody. Our staff focuses on certain things and that institutional knowledge matters. But again, we want to get an idea of how is everybody using our organization and what does everybody need. So with that, I'd like to start with the data. This can be looking at things like what have our prices been historically. If we have price variances, such as depending on the product, like early bird or regular registration, or for membership, if we offer certain discounts if you register by a certain date, taking a look historically at how has that moved people, has it had a big impact or not. Also, outside of price, I like to look at value and engagement. So what have people been engaging with? Which topics, which types of content? Is it, member only podcasts versus webinars versus blogs and articles? Is it more reports and survey results like salary surveys and benchmarking? So what types of things are they really engaging with out of that big old list of what you offer? And that gives us an idea of what matters. Now, this is an aggregate. You probably would have a hard time then dishing this out by segment, and that's okay. If you can, great. But some of us are still behind in our technology implementation. AMSs are catching up, all of that, LMSs. So do what you can, but I like to start there and get an idea of what's actually going on. What is the consumer behavior? The second step to me is optional. I would gladly take it out, but most boards care about this, so we have it there. And that's a competitive analysis. Now, the thing with competitors is this is how most associations price right now. They're either doing small incremental increases, or they're looking at competitors and saying, well, this is what they charge, especially for a new product. They try to find comparable products and price in line. But the problem with the competitive analysis, and why I don't personally care about it and will gladly take it out of any project that we do, is that you are assuming that your competitors are pricing right and are delivering the right value. And you don't know that. When we look at our competitors' sales pages and see what they're charging and what's in the package, we give them so much grace and assume that they've got it right. But then when we look at our own sales page, we say, well, we know we just kind of pulled that number out of thin air. And we know we say they get these 10 things, but like the podcasts haven't been updated in 6 months and this isn't that great, but these are good. Like we know our own value and price and how it came to be, but we assume everybody else has it down and they do not. You cannot keep up with the Joneses. They're probably guessing just like you. So it doesn't make sense. But if you want it, go for it. Honestly, it's a controversial opinion, but we see that it barely makes an impact. If I do a project with a client, it might impact at most 5% of the final outcome. I feel like it's a waste of time and energy, but it's there because some people think it's important. The third step is a value analysis. So now this is where you start talking to your audience. So if it's members or attendees or sponsors, whomever that is, and you want to start getting that voice of the customer. Now, the reason that you're starting with your data and maybe competitive is it gives you an idea of what's out there and what they're doing so that you have a level of information and knowledge that is current as you go speak to them. For the value analysis, there's a few things. One is, and I'm actually, is it okay if I do a quick shameless plug? Because I know you're going to mention it, y'all, yeah, but we do, this is a lot. This slide I'm sharing a lot, but it is in our book and you can download the book for free. So it's not a sales pitch. You can buy it on Amazon, like the paperback is available, but everyone can get it for free. So this is not about us making money. It's about, we actually outline how to do it in templates. So if you're like, holy crap, he's sharing a lot of information and how am I going to remember this? We give it away. It's on our blogs. It's everywhere. But the value analysis, we recommend doing a survey first. This is where you start with demographic questions. You can create segments and then see what value do people like based by segment. That helps them later with marketing. So whatever segmentation questions matter to you, but we ask name, email, may we follow up, and then dive into it. If it's membership, are you a current member? Yes, no, but we have been in the last 3 years, or no. So you can get lapsed non-member member segments. If it's an event, have you attended? Yes, in the last 1 or 3 years, or no. And then you can segment questions from there with logic flows. You know, if they are engaging, we like to list out all of the benefits. So think of those 10 bullets of membership of what they get. And then we'll ask a question for each one. We'll line it up. So let's say they get a journal. We say, do you utilize this member benefit? Yes. No, because we didn't know about it. No, because it lacks value, or no, because I don't need it. Then from there, we ask questions. So if yes, how valuable is this on a scale of 1 to 5? Is this something that keeps you renewing your membership or coming to the event or continuing to be a sponsor? If they say no because they didn't know about it, is it something that you think you might be interested in? Yes, maybe, no. If they say no because it's not a value, then what's missing? What do we do? Is it the user experience? Like what's wrong with it from your lens? And do we then notice trends in aggregate or by segments of value adjustments that are needed? If they say, let me think, not a value, didn't know about it, not needed, why is it not needed? For example, we typically see like career centers are more important for those that are in hiring and leadership or early career, but kind of in the middle, they're changing careers every 5-10 years. They don't care as much. But also by segment of generation, younger millennial, Gen Z tend to job hop every 2 to 3 years. Boomers, Gen X tend to stay around at a job a little bit longer. So now you're starting to notice all this. You're starting to get the idea of what value matters. You might ask some pricing questions like, for the price paid, is the price and value in alignment? Is the value higher or is the price higher? That gives you an idea of, do they feel like they're being nickeled and dimed? Or if the value's higher, then you might be able to go up. So we do that, then recommend focus groups. If it's something that's member facing, if it is sponsor facing, we recommend interviews. We do not want to bring them together in a focus group because that's one time I don't like them in the sandbox together. So then we're clarifying, we're getting more qualitative feedback. Okay, why? Or what might this adjustment look like? What might improving this member benefit look like? How do you specifically need it to work for you? And then from there, we are going to recommend packaging changes. That's when we start reimagining what that product might look like and what changes might we make, what's feasible. So then we go into pricing analysis and we say, okay, great. If we make these changes, and there's two methods I recommend here in doing both. The first is the Van Westendorp, which is an open-ended model where you basically say, hey, we're looking at adding these things or enhancing these things in this product. If we did it, how much more would you pay? And you ask a series of questions. Again, in the book, in our blog for free, you can Google Van Westendorp. It's everywhere. So we're not gatekeeping, but you basically ask a series of questions and they answer to get an idea of how much are they willing to pay. So you might find out, hey, they're willing to pay an extra $50 or $100 per year for membership, or an extra $300 per year for conference if we do this adjustment. And then the second round of survey that we recommend is conjoint analysis, which is where you then have the price and you say, okay, here's the current membership and the features and the price. Here's the new enhanced membership and the new price based on that first survey. Which one would you enroll in the next year? And then optional why. That allows you to then make sure that you're hitting the target. You're not throwing spaghetti at the wall. You know that the majority of your people are going to move to that upgrade. So that's the pricing analysis. And then from there is implementation. That's the long road. You might create a roadmap that's not just 1 year, but 2 or 3 years. You might say, hey, we're going to make these value adjustments in the next year, but then these are going to take 2 to 3 years. And so the price might go here and then here based on that. So that's when you implement, you communicate price changes, you update financial forecasting, update tax systems, all that good stuff. But that is the process that we recommend. Again, it is a bit deeper. I've only had one person ever tell me, this sounds too complicated. But for most of us, we're like, no, if we're throwing spaghetti at the wall, this is all based on data. You're looking at historical, and then you're making data through the value and pricing analysis so that you're making sound decisions, and it's informed by the audience that you're selling to.
Yeah, I definitely find that people are interested in that and knowing the process. I'm sorry, Sharon, go ahead.
I was just going to say, Michael, this is a lot of great information, and you've given a lot of detail behind this plan. How much time is involved from start to finish on this?
Yeah, so it varies on, team bandwidth, all that. If you bring in an outside consultant, there are others that do this, not just us. I typically recommend a historical data analysis is usually about, up to 4 weeks, 2 to 4 weeks, depending on how much data you have. A competitive analysis can usually be like a week or two. That's not that hard. The value analysis and pricing analysis is where it takes time. Usually I recommend a good 8 weeks for each, because if you're doing a survey in value and then you're doing either interviews or focus groups, that could take about a month for each part. Pricing analysis, 2 different surveys could take about a month each. So that can definitely take a little bit of time. So in total, you might be looking at something like 4 to 6 months. And then implementation, again, that could be another 3 or 6 months or 2 years. It depends on how much you're doing.
So it's interesting because when we put budgets together, we usually say, hey, that cycle, you need to allow that 4 to 6 month timetable as well. And the two, they're going to go hand in hand because you've got to determine your pricing, but it's still got to come into play and fit in within your budget.
Exactly. And sometimes we'll have people come to us like when they're first inquiring and say, we need to know the price in 3 months. That's when our budget's due. And I'm like, here's what I can do for you, but we cannot do a proper project with integrity. But I might be able to look at their prices and based on my knowledge of the industry, give some, psychological hacks and recommendations. But what I typically recommend is start about 6 months before your budget is due because you're going to get this information scaffolded. But I agree with you. It takes some time. It's not a quick, like, if you're going to throw spaghetti, you can do it in one meeting. If you're going to do it the right way, that has a plan and a roadmap for the next few years, it is going to take some time, but it's worth it.
Yeah,
Great
I love it.
information.
And Sharon, kind of to your point, I think that for calendar year associations anyway, we're actually probably right on time for folks to start thinking about it and getting it started and really figuring out how do they need to fold that in. And so, Sharon, since you mentioned the budget and the planning process, why don't you tell us a little bit about how you help organizations understand, what they're dealing with, what their future is, all of that.
So the big thing, the starting point is always going to having that financial information available. And that's where you've got to make sure that you're designing your systems to do all of that. So as we get into this pricing for association, I love this graphic. It really gives us a good picture of how everything interacts. So Michael, I love how you did the segmentations and looking at different programs or geographic areas, whatever it may be. But as we mentioned before, it all has to tie back in. So we need to look at what is the mission that the association is trying to achieve? What's our financial health? Can we support it? Or do we need to look at some means to postpone it? It's all part of putting together that bigger picture in the development of the budget. And this ties in exactly with the pricing of setting all of that. Because with those two things, that gives us then that capacity for innovation, and that is the potential growth going forward. So we always need to keep in mind the short-term and the long-term goals of the association.
Yeah, absolutely. And this graphic is also great because I think, Michael, in your book, and this is one of the things that we talked about, is in your book, you talk about the importance of finance and having a healthy bottom line. We actually have a lot of clients that come to us initially. They don't think this long after working with us, but they come to us thinking that they're not supposed to have a profit, that they're not supposed to have any cushion on their bottom line. Mm-hmm. And your work, and then hopefully working with us, we're really focused on making sure that they do have enough to fund that bottom line and build the capacity for innovation.
Mm-hmm. Absolutely. And I know we're actually going to talk about that a little bit coming up. So I'll give like a quick preview, but for me, pricing is not about greed. And actually it goes really well into this next slide. So I'll kind of hit on it here. And then I know we're going to talk about it a bit more coming up, but for me, pricing is not about greed. Value-based pricing is about determining what is the willingness to pay. Now, just because there is a willingness does not mean you have to charge that much. So one example that I always love to give is the iPhone or any smartphone now that you use. It probably costs Apple something like $100 to $300 to make that phone. And if we wanted to do cost plus, which is what most of us have been taught, meaning you figure out how much does this cost us to put on and just slap on a 20, 30% profit margin. If we did that, they would probably charge us $300 or $400 for the iPhone. But they know that we are willing to spend $1,000, $1,500 on these devices, and every 2 years, 3 years, 4 years. So the willingness to pay is much higher. Now, the difference, I would say, is that a for-profit entity, their primary focus is profit, right? That's why they do not have our tax classification. So with that, they want to pretty much go to that peak of where they can go. We instead can decide where do we want to fall. So it's not about greed, but when we are talking about adding more staff because we're at capacity and we have more work to do in our mission, or when we talk about implementing more technology or programs or giving away more scholarships or whatever the case is, or programs that don't generate revenue, a lot of DEI programs, things like that, you need money to do that. So it's not about greed, but it is about knowing, can we charge more? Are they willing to pay it because it's a no-brainer for them? And if so, how do we do that? So I'm a big proponent of value-based pricing rather than cost plus, because it gives much more options. So yeah, that's pretty much value-based pricing. And I would even say the benefit to it.
Yeah, absolutely. I think we can be comfortable with cost plus because we, again, as finance people, maybe we understand it. And even if we understand revenue, we want to make sure that there's data behind it. And so that's, again, why we're really interested in this conversation. The next slide is, and again, this is something that we had talked about before, where I really, even though I agreed with everything that you were saying, the light bulb really turned on when you started to talk about this. So why don't you explain a little bit about the 3% rule and how we should think about the impact of these pricing changes?
Yeah, so I know we have a lot of finance people on, but I still like to keep the numbers simple because not all of us feel like doing math all the time. And about half of us here are not finance people. So let's say you have a $100 product, and most profit margins of associations are about 30%. It can vary, the product varies, all that. But typically, I see about a 30% profit margin, or less. I don't normally see more. So 30% is actually going very liberal and giving a lot of room here. Now, let's say we also normally sell 100 units of this $100 product. Maybe it's a quick like online training. Most people are very comfortable with discounts. And when I usually ask this, if I'm doing a training in a room, I'll say, what percentage would you give? And anything below 10% is considered why. Normally we hear a 10 to 30% discount. So let's go 10%. We'll go low end of what's acceptable. Because like a 5% is like, what's that really doing, right? So if you give a 10% discount on that product, most people would think, okay, we need to register about 10 or 15% more people. So if that kind of gets them in the door, great. But they're thinking revenue. They're not thinking profit. And this is where the power of pricing comes into play. So with that example, if you give a 10% discount, you're actually losing 1/3 of your profit, because if it's a $100 product with a 30% profit margin, that means $30 is profit, where you can reinvest that into your reserves or new programming, new staff, whatever. 70% is this is CAE hat, those of us that earn the CAE, or just finance people know this too. The other $70 is going to your fixed and variable costs, your direct, indirect costs for putting on that programming. So really, when you discount 10%, $10 off, and you're losing 1/3 of your profit, that means you need to register at least 50% of people, 50% more, just to break even with your profit. So if you think a $10 off $100 is going to get you from 100 to 150 registrants, I don't see that. And I think all of us anecdotally would say, that's not going to get us to those numbers, right? It might get us to 110 or maybe 120, but you're actually losing money. It would have been better to not offer the discount and just have your 100 people. So a lot of people don't realize the impact that those little pricing decisions have, yet we actually see that people discount all the time. Now, on the flip side, though, the downside is discounting really hurts you. And if there's one thing I can get associations to do, it would be stop discounting. That alone would really help your bottom line. But on the flip side, the opposite is true. That also means that incremental price increases are going to have a huge impact. So let's say that $100 product, we go to $103, a 3% increase. No one's going to bat an eye at that. And yet you're increasing your profit by 10%, not 3%, because that $30 is now $33, assuming that your costs all stay the same and you're just doing a nominal increase to your price. So it has a big impact. And then imagine, what if you go to 110? That's a 25% increase in your profit. So of course, we recommend, having gone through the process a few slides ago, you might make value adjustments when you're doing larger price increases, but most people can usually get away with 3 to 10% without adjusting value. But that has a big impact. It usually has a 10 to 25% impact on your profitability. And I think we could all use more money. We could all use more revenue and profit to drive our mission forward. So the power, the impact of pricing is a big lever. And it's why it's something I think everyone should pay attention to and not ignore for 5, 10, 20 years, because you're really hurting yourself by doing that.
Absolutely, absolutely. Okay, so now this is our second poll question, and I'll say this a couple of times. make sure to click on the screen where you see, so there's a slide visible. Click on the slide itself, and that's how to answer the poll question. So the slides have to be visible, and you have to click on the slide. This poll question is, how would you assess your organization's readiness to measure the preferences of your members when considering pricing changes? So either you've heard Michael before, and so you're extremely ready. Maybe you've somewhat familiar with these concepts, so you're moderately ready. You're slightly ready, meaning you've been researching and trying to figure out what's right. And so now this is a good start, or you're not ready at all. And so you're happy to be here. So now you can think about being ready. Again, click on the screen. You have to see the slide. The slide has to be visible. Click on the screen in order to answer the poll question.
And while we're waiting for everybody to fill out the poll, I'm just going to mention, Michael, I have for years been trying to get people to understand this concept and have been preaching it left and right, but you definitely have brought the science to it now, which makes it so much easier for those in the finance world to completely understand, but also, our executive directors, CEOs, they're now getting it too.
Yeah, absolutely. The good thing I think is people, when they hear that, that's usually enough of like a, whoa, okay, to put pricing on people's minds and understand. I think a lot of people think, oh, we need new revenue, we need a new product, we need more non-dues revenue. But the reality is you've already got a suite of products. And if you look at the pricing and analyze it, the ROI is typically going to be there for the time that you invest. And you're going to, just like, right, like acquiring new members takes more time and money than keeping your current members. Creating new products is going to take longer to make more money. You can increase the price on something and over that next year actualize it if you do it right. But creating something new, it's going to take a lot longer. So I think we have to take care of what we have and be intentional with the programming that we have.
And there's a question in the Q&A box, and I know that you work with both professional as well as trade, so those that have individual members and company members. Is anything that you've said so far, would you say anything different or give any different advice for those associations that are company or organization focused?
Yeah, that's a great question. So the process doesn't change, but some of the questions that we ask in the value analysis and then the pricing analysis do change. High level, I would say we always ask, no matter individual or trade, type client, we always ask, are you the purchasing decision maker, or something along those lines? And typically, like, yes, final, yes, strong influencer, or no. So for a trade type association, what I focus in then is what are the discrepancies between those who actually make the decision to be the member or send people to the event versus those who are in the membership, because those who are in it still matter their value feedback, right? Because they might say, no, I don't use this, or I don't care to go to the event. And then the purchasing decision maker doesn't care. They're not going to tell someone to go. But we also care about the price perception of the person deciding. They know the purse strings, they know what the willingness to pay is. So yes, we do segment that out and look at it a little bit differently. And then when I do focus groups, I segment them as well and really lean into pricing a bit more with those purchasing decision makers when we get to the pricing analysis. But I still want to hear value and perception of value from everybody, no matter what. So there are some nuances, yes, but the process itself is pretty much the same, with just some caveats there.
Interesting, and that's probably also since there's a lot of science here. There's a lot that goes into this, and so is there any distinction in the book that you mentioned? Do you talk a little bit about the differences between maybe individual members versus company members and how that work? Okay.
Yeah, we do. And also even down to like value propositions, how you might write those differently if it's an individual org, if it's a trade org, then to the purchasing decision maker, and then to those that are just, members. So yes, we give examples of all of that. Yes, in the book and on all of our blogs on our website.
Okay, great. And so one of the things that you've said so far is you talked a little bit about segmentation. You've talked a little bit about, some of the different things that we can consider. And it seems like for us as a a partner, the finance team as a partner, the strategic considerations in pricing might be a great opportunity to think about maybe some scenario planning. So to think about if certain aspects of this are more important than others, maybe to do some scenario planning. I don't know if Sharon, if you want to talk a little bit about the budget process and how you, might lead organizations through scenario planning, and then Michael maybe to chime in as she goes.
So one of the things we always do is we try to look at the different scenarios. What's the best case outcome? What's kind of the middle of the road? And what's a worst case outcome? And we've all seen, especially with the last few years of COVID, that best case doesn't always happen. And so if the best way you can prepare is looking at these different scenarios and looking at budgeting for them. What if I increase my dues? What if I lose some of my members? So we want to tie that back to what Michael was saying with the profitability and create these different scenarios that we could lose some members. So by losing volume, but having the pricing in place, what's that do to our bottom line? So we're always looking at that part to come into play. Adding new members or new customers, whatever the case may be, how is that likely? And again, it could be your different scenarios you're lining up in your budget process of to acquire new customers or new members. It's going to take a little more money to bring in a new member versus keeping the old. You may have to spend some money on your marketing and get the word out of the value that you're providing to your members. And then, of course, always looking at the price perception here of trying to look at, are we going to outprice our competitors? Are we in line? And again, you can do this through the different scenarios of your budgeting process to take this into consideration.
Yeah, and Jen, I would say this is in alignment with things we've talked about offline, but this is where I would say, we talk about, like you've asked me before, what about costs? Like you don't really talk about your costs too much. How do you consider that? And I think this is where I say it's not that I don't care about the costs, because cost plus is looking at the costs, then adding on your profit margin. Value based, what if the value is below the costs? Well, then to me, that says you don't have a business model, right? Because you can ignore the value based pricing and say, yeah, this Yeti cup costs me $30 to make, so I'm going to sell it for $40 and make $10 a pop. But if they're not willing to pay it, you're not going to sell any. And how many times has an association launched a product and it didn't sell how you thought? And therefore, it's because before you even make the product, you should be determining the value and the willingness to pay. In corporate America, they typically do that. Product development is determining price before it launches, not after. It's not like, hey, it could be a great idea, but is it a viable product? That's where we have to put our business mind on. So the way I like to look at it is like a house. You have your basement, you have your ceiling. So your basement is your minimum cost to charge to cover your costs. That's your minimum price. Anything above that is profit. So you could take that basement and you can say, okay, we're going to add on, again, 10, 20, 30%, whatever. That's one methodology. But again, how do you know that you're not leaving money on the table? How do you know that that's actually the ceiling? Value-based pricing says, let's find the ceiling. And the ceiling is the point at which the vast majority are willing to pay for it. And that goes into the Van Westendorp model, which again, you can Google, it's in the blog, it's in the book, all that. But that kind of determines, here's that optimum price point based on your audience and their willingness to pay. Now, when you take these strategic considerations in pricing into account, that's where you decide, do we want to go with that ceiling or not? You may not. So let's say your basement might be $30 and your ceiling might be $100. You might say, hey, we can serve 90% of our audience at $100, and that does give us maximum profitability. So if that's your goal, the first objective. But what if volume is our goal? And we know that if we go down to $70, we would serve 98% of our people instead of, I think I said 90 at first. So we actually want to bring it down. And yeah, we won't make as much profitability wise, but we're going to serve more people and we're still profitable. So that's great. Or is it about acquiring new customers? Therefore, do you do some kind of specialized pricing for them or favorable price perception? So is it more about fairness? You might see that most people, especially let's say you have a tier, this goes into organizational trade associations. I've worked with them where it's based on the number of people that are members. And typically those in the smaller tiers do not have as much of a budget to spend on additional, professional development and education and all of that. So for them, price perception might be, hey, if you're in this small tier, we're going to give you 2 or 3 credits towards events every year, like online events. But then you have to price that well against the next tiers so people don't just go down. You have to make it make sense. It's a whole ecosystem. But what is your pricing consideration? What's your goal? And so the association can decide whatever they want between the basement and the ceiling. But if you don't actually know where your ceiling is, you're throwing spaghetti.
Definitely. Interesting. So it's definitely going hand in hand with, thinking about what's important, so it's not just the value, but what's important, what are you measuring, what are your outcomes? And so one of the things I think, Sharon, again, I'll have you start and talk a little bit about some of the key financial metrics. And then again, Michael, if you could just talk, because we're really focused as finance people, we're really focused on the finance metrics, but I know there's a whole host of other things that you talk about as well that are important. Sharon, why don't you get us started?
Okay, so before we get into looking at specific metrics, we always have to make sure we've got sound financial statements that we're going to be pulling the information from. And we highly recommend that you use accrual basis accounting for your financial statements so that you eliminate the timing differences of when the money comes in and out. And you're looking more at when did you incur expenses and when did you properly recognize the revenue when it's earned. And so if you've got sound financial statements, then you can start pulling from there and creating what's meaningful to you. And you need to decide what it is specifically. It's not everything fits everybody's case in this situation, but you want to decide, first off, look at your budget to actual before you even get into ratios and make sure we had a plan. Are we following our plan? If not, why are we off? Because that's going to help keep our ship on straight course there. Then you also need to make sure that your financial statements are going to give you the information down to the level that you need for the benchmarks and the ratios that you want to compute. So it might be a lot of what Michael was talking about, designing your accounting system so that you can track the revenue and the cost by program, by whatever segment is meaningful to you in all of this. And developing a forecast, because that's going to be a key factor in recognizing, gosh, what is my cash, my ups and downs that I need to monitor throughout this. So having those in place, then you can turn to creating these ratios and benchmarks. We've talked about retention rate. That's something, I don't know how many of you are actually tracking it, but we know it costs more to bring in new members. So that might be something that you want to monitor, along with a lot of these other suggestions we have. The lapse rate, that's your cash flow tied up. How long does it take for the members to renew their membership? You want to get that cash in the door sooner and be available for your use. But these are some suggestions out here. You want to always make them meaningful. And so you have to understand, well, what is it? Is this a good ratio or a bad ratio? And that's where you can turn to, one, tracking it within your organization, but two, looking at outside sources. Look at other associations that are comparable to you and see how their ratios are comparing. A great place to look for this, I know ASAE puts out a lot of this information so that if you're members, you can grab it and use it for your own comparison. Michael, you got anything else you'd like to add on this?
Yeah, I would say a lot of this or a lot of these points are the types of things during data analysis that I would also recommend looking at and then creating KPIs around, so that as you move forward, after you do a proper pricing and value analysis, you can then year over year kind of look at, are we hitting it, or what adjustments do we need to make? How engaged are people in certain areas or components? That also helps you with determining sunsetting, because I always say there's kind of two axes that I recommend looking at. One is, how valuable is this? Meaning, are they actually using it and they enjoy it? And then the second axis is, how much effort does it take our staff to pull this off? If something is low value and it's taking a lot of effort for your staff, it's time to sunset it, right? But even if it's low value but low effort, it might be something you give away for free, like a newsletter, right? Blogs, things like that. But then you kind of know what to package or what to charge for those higher value items. And part of that pricing might also be how much effort is it taking your staff, or part of that perception is gatekeeping certain things that take more effort from your staff and limiting how many people get access to it by charging a higher price. So when you think of like sponsorships, you may not be able to have every sponsor host a lunch, right? Or a networking event in the evening, but you limit those and you say, we only have this many, and that's a premium thing. So that's kind of where I would add a bit too. So looking at all this data and then also funneling it through the lens of value and pricing strategy.
Thank you. So here are some other key things to think about: your systems, applications, how to report. One of the things that I'm hearing that you saying is not just thinking about your KPIs, but also maybe kind of cross-referencing, what is your retention rate, but by segment or by product, so kind of combining some of the things that you're reporting on for the analysis. Utilization of technology, and then Sharon, you mentioned also kind of looking ahead and forecasting cash flow. Do either of you have any advice for folks about, who needs to be involved in this effort, and how you work with some of these different areas in order to implement this kind of thing?
So this is going to be the same as when you're working through your budget. You don't want your finance team to be working in a silo. It's so important that they're in collaboration with everyone else in the organization. You've got your CEO on the top, who's going to be approving and kind of guiding where the direction that the association is trying to go. So we still need to make sure that they're involved. The program folks, your other departments, they're all involved in this process.
Absolutely.
Yeah, I agree. And I think when it comes to who should be involved around the pricing and value decisions, I think whoever is in the department or touches that product, leaders should be. And I think it's even great to have people who are not leaders, who are coordinators, managers in that conversation as well, because they'll have institutional knowledge and insight that others may not have. And then outside of that, of course, CEO, I think that matters a lot. So I like to keep it kind of small. I don't think everyone in the organization should look at pricing and value for everything. But I do think whoever kind of owns that, if there is a product person or a strategy or operations person, and then CEO, and then from there, anyone in that department that manages that product.
Okay, a nice, good cross-section. Good advice. Here's our third poll question. Again, it's a slide. Click on the slide. How do you typically decide that your organization needs to reevaluate pricing and membership dues? Is it done through regular financial assessments, member feedback, people just giving you feedback, industry benchmarks, or other? And again, if you've got other things that you're using, we'd love for you to pop that in the Q&A so we can react to that as well. It's been a great conversation. I know we have a few slides left, so I might kind of rush us through the next ones. I'm going to, let's see, we're only at 50% right now, so I'll give us a couple more seconds on this.
This is a tougher question for people to answer because it really involves thinking through what's driving it.
Yeah, good point. We're at 75%, so let's see what some of the answers are. So through regular financial assessments, so where are we financially, and then what do we need to do to make sure that we're sustaining the organization in the right way? Member feedback, industry benchmark, so it's about half financial assessments and a little bit more than half financial assessments, and then other things. A mixture of those things, and then questions from the board and staff. That's a good point. I don't know if we've mentioned the board as much in this discussion, but board is one of the things that someone in the Q&A has shared. Okay, we'll go to the next slide. And this is really about understanding your numbers. And maybe Sharon, you can kind of give us the outcome of your situation that you dealt with so many years ago.
Okay, so with my organization, we hadn't raised dues in a lot of years. The members were used to a steady, dependable amount they were going to pay for dues. We went through, we worked through our numbers, and we realized that we needed to raise dues 300%, no small feat. So in the end, we decided it was a plan that was developed not only with finance, but also with the executive team, put together a marketing package, went out and did live in-person meetings starting at the local level. Let me give you a little background on this organization. Their members are in the medical industry. Their revenue stream is heavily reliant on Medicare and Medicaid, and at the time there were a lot of legislative issues that could possibly cut their revenue stream. And so the two people hired were key in maintaining the levels where they had been. So that was exactly the program, that the message that was conveyed to the membership, that what was the value they were getting for the membership dues. It was part quantitative, but it was also qualitative too for them. And we hit their bottom line in the message that was going to them. So in the end, they did agree to go ahead and approve the 300% increase in the dues rates, and they did not lose any members.
It's a great outcome.
So
Sounds like it's a good outcome, a little bit different than what you would have recommended, Michael, but they did talk a little bit about value, but just maybe in a little bit a different way.
Yeah, I agree. I think, being able to communicate, hey, we need these, we need pay to maybe go here to keep up to standard and have the level of expertise to lead our organization, being able to communicate that we need these additional positions. This is the value that they're going to bring. These are the intended outcomes, how it's going to benefit our members, our field, and the greater world. I think all of that's important. So yeah, they did put the cart before the horse, but at least it turned out well. But I do not recommend that process, because I would guess that the vast majority of the time, if not 95% of the time, it's, you're probably gonna have a fail. So fortunately it worked out for them. But I think we'd all agree, don't increase your expenses before you've adjusted the budget and the revenue.
Yeah, absolutely. I think sometimes it's sneaking up on us with inflation being the way that it is. A lot of organizations, like you mentioned, I think we talked about the cost of in-person events and how, that's really becoming something that associations are having to contend with. So sometimes it happens. And so it's good that we're having this discussion so folks can, again, kind of take that into consideration and make sure that they're factoring that in. Just kind of summarizing what we've talked a little bit about, some of the best practices here. Number one is, and I think Sharon and Michael, you both agree that it's really about value, that this whole conversation that we're all about delivering value, both, the long-term financial sustainability of the organization, and then how we're thinking about the pricing of these individual either products or events or dues. It's all about value. And that the process is important and can take a while. It's an investment in time, and that to really do it right, we need to think it can take from 6 months to even make that decision, to another 6 to 12 months to implement that. That it's really could be, if we think about it, because you talk about maybe you want to do a few things at a time, that you're not evaluating all of the products at one time, right? But that you might have to have this a little bit of a continuous process. Is that fair?
Yeah, I think to try to, listen, if you've got like 20 products, it's too much to do it all at one time, even 10. I typically recommend look at your 990, look at your financial statements, pick your top 1 to 3 profitable, now not revenue. You're probably going to see that your event is your highest revenue, right? Between the sponsor dollars and the attendee registrations, all that. But profit margins are you're either probably in the negative, or you have a slim profit margin with your event. So don't look at the highest revenue, look at the highest profitability. That's probably going to be membership, online education, certification, things like that. Then focus on those first. That's where, again, when you have that bigger profit margin and then you go up in price, you're going to have a better lift. You could argue, well, why not go with the event and try to get it to where it needs to be? You can do whatever you want. That's just what I recommend. I think it feels better when you have a win in the first year or two, and then it gets the momentum going. So maybe pick 1 or 2 products a year, no more than 3, do the process, then pick another. And then, over a 5-year or 10-year cycle, you're probably hitting all of your products, and you have a roadmap for the next, 2, 3, 4, 5 years for each one. So you're making incremental increases and everything's kind of in line step.
That's great. That's great advice. So this is our fourth poll question, and then after this, we'll just do a recap. But how likely are you to consider integrating these concepts into your association's pricing strategy? Very likely, somewhat likely, not likely, and it depends. Okay, I'm reading. We've got a question in the Q&A. So for those of you who have to leave, I think we're right at 1 hour. Hopefully you can stay on just to get the last recap, but then there's also a question. Our trade association has a due schedule that company pays on sales volumes, and we haven't changed that schedule in years. We are now thinking that we need to increase the schedule itself. Even if they have no sales volume increase. Any advice for that kind of a situation?
Yeah, I think it's great that your industry is growing and that most of your members are successful and are growing in their sales volume. Here's the thing, they're not going to know necessarily like what each tier is. If they're moving into a new tier, they just know what they know about it. So I still think you should be going up in price. So I think it's a great thing. And I do think that should go up. I would also say, and this is probably top of mind, but this goes back to the data analysis. I would also look at where are people falling, what are the current bands of revenue, and are they properly aligned? Meaning, are there also opportunities to look at, you might have a big gap of 25 to 50 million a year in revenue and find, well, most people are either at like 30 or let's say 45. So do you split it? Don't go making a ton of changes, but you look at everything you consider. So I would look at that data. I would still do increases. And that might even be something great to communicate. Like our members are successful and, we keep seeing this percent of organizations have growth in sales volume. That's a great thing.
Yeah, absolutely. All right. I'm going to flip to our recap. So again, thank everyone for joining us for this topic. We definitely think that this is one of the, emerging challenges, one of the things that associations are facing in pricing strategies. And again, just think value as at the core. And 2, think about the metrics, what's important. Make sure that you're thinking about what your priorities are and that your financial and other systems are aligned to be able to give you that information. And also, hopefully we've shared some best practices and lessons learned so that you can make this a little bit more of a scientific, a little bit more art in terms of a little bit more science in terms of on that art and scale, art and science scale, that you can make it a little bit more on the science side. Anything else that you want to say, either Michael or Sharon? Again, thank you to both our panelists. They've done an amazing job, shared a lot of really good information. Anything you want to say in closing?
Yeah, I'll say that I think I saw that there might have been a typo in the URL. So we're at pricingforassociations.com, and you can go there and get the book. Or if anyone would like to, talk to us, schedule a call, that's there as well. So yeah, but thank you all for having me on today. It's been really great being with y'all.
Thank you.
And I'd just like to piggyback on that. If you need any help pulling together your financial information, so you've got that first step, and we can help you with that as well.
All right, thank you both.